pause for a moment. Because while most people were watching markets move by a few points, something far more important quietly changed underneath the entire system. Not a rumor, not a theory, not a prediction, a confirmation. The kind of confirmation that doesn't appear in headlines until it's already too late to react. The kind that reshapes how money works, how power moves, and how wealth survives. Gold is no longer behaving like a commodity. The dollar is no longer behaving like a ruler. And when those two facts collide, history does not whisper, it breaks. Most people will only understand this after the damage is done. After savings lose meaning, after numbers on screens stop protecting real lives. But a few will see it early, and that difference decides everything. Welcome to Boring Currency Registry. If you've lived long enough to see systems rise, promises break, and temporary policies become permanent, this channel is built for you. If you value calm thinking over noise and preparation over panic, consider subscribing, not for excitement, but for clarity. And tell us, from which part of the world are you watching this moment unfold? It began without celebration, without emergency meetings broadcast on television, and without dramatic speeches. Most people woke up, followed their normal routines, and went on with their day. Markets opened, phones were checked, news feeds were scanned. Nothing looked unusual on the surface. Yet beneath that calm exterior, something fundamental had shifted. They did not announce it as a revolution. They never do. Instead, it appeared as a technical adjustment, a routine settlement choice between large economic players. But for those who understand how monetary systems truly change, this was not routine at all. It was confirmation. For decades, the global system relied on one assumption: that trust in the dollar was permanent. That assumption allowed governments to borrow endlessly, corporations to plan far into the future, and individuals to believe that numbers on a screen represented real, lasting value. But trust is not infinite. It erodes slowly, then all at once. The confirmation came not through speeches, but through behavior. Sovereign entities, countries that think in decades, not quarters, began settling trade outside the dollar system. Not as an experiment, not as a hedge, as a deliberate choice. And the asset used for settlement was not another currency. It was gold. This mattered because settlement behavior reveals belief. Nations may talk about cooperation, stability, and reform, but how they settle accounts shows what they truly trust. When gold re-enters settlement, it signals that confidence in paper promises has weakened beyond repair. The dollar did not collapse overnight. It did not need to. Monetary systems rarely fail through sudden explosions. They fail through quiet substitutions, first at the margins, then in parallel systems. Finally, as the old structure continues to exist in name only. For years, analysts debated inflation numbers, interest rates, and policy decisions. They argued over whether the system could be fixed with better leadership or smarter regulation. But those debates missed the core issue. The problem was not policy error. It was structure. A system built on unlimited debt requires unlimited confidence. Once confidence begins to fade, the system must either impose discipline or lose relevance. Gold represents discipline. It cannot be printed. It cannot be adjusted by committee. It forces limits where paper systems prefer flexibility. When gold returned to settlement, it did not do so. The decline of the dollar did not begin with a single bad decision or one failed policy meeting. It began long before, hidden beneath decades of convenience. For years, the system worked well enough that few questioned its foundations. When problems appeared, they were treated as temporary disruptions, not structural warnings. The dollar's power came from its role as the world's reserve currency. Nations held it not because it was perfect, but because it was familiar, liquid, and widely accepted. Over time, this role created an imbalance. The United States could consume more than it produced, borrow more than it earned, and still face little immediate consequence. The rest of the world financed this behavior by holding dollars and U.S. debt. At first, this arrangement seemed beneficial to everyone. Global trade expanded, financial markets grew deeper, credit became abundant. But abundance carries a cost. When money is easy to create, discipline fades. Debt grows faster than productivity. Promises multiply faster than the ability to honor them. The problem was not that debt existed. The problem was scale. Debt reached levels where repayment in real terms became impossible. At that point, repayment could only occur through devaluation. More currency units would be created to meet old obligations, quietly reducing the value of each existing unit. Foreign reserve holders understood this risk. They studied balance sheets, not political speeches. They saw deficits that could not be closed without monetary expansion. They saw interest expenses growing faster than economic output. And most importantly, they saw that confidence, not law, well, that was the only thing holding the system together. Confidence is fragile. It does not break loudly, it weakens silently. Central banks noticed that holding dollars meant accepting guaranteed loss in purchasing power. Even when yields rose, inflation rose faster. The result was negative real returns. From a preservation standpoint, this made little sense. As trust declined, diversification increased. Some countries reduced treasury holdings, others stopped adding to them. Many sought alternatives that did not depend on another nation's internal politics or debt management. This was not hostility, it was risk management. Attempts to restore confidence followed familiar patterns. Interest rates were raised, new financial tools were introduced, digital currency projects were announced. Yet none addressed the core issue. They changed the form of money, not its nature. A digital promise is still a promise. It still requires belief. The dollar's challenge was not competition from another currency, it was competition from restraint. Systems anchored to physical limits offered something paper systems could not: credibility through constraint. As more trade settled outside the dollar, its network advantage weakened. Once alternatives exist, dependence declines. Once dependence declines, power follows. The dollar did not need to disappear to lose influence. It only needed to stop being essential. This is how structural decline works. It is not dramatic. It is mathematical. When obligations grow faster than trust, the outcome is predetermined. By the time public debate catches up, the shift is already underway. The dollar's fall is not about failure, it is about replacement. And replacement rarely asks for permission. Gold did not return to the center of the monetary system because of tradition or nostalgia. It returned because it solved a problem no modern policy tool could fix. In a world where trust was weakening, gold offered something rare: certainty without dependence. Unlike currencies issued by governments, gold does not rely on political stability, fiscal discipline, or public confidence in leadership. It does not require enforcement. It does not promise future payment. Its value exists in the present. For institutions tasked with protecting wealth across generations, this distinction matters more than ideology. For years, gold was treated as a passive reserve. It sat in vaults, dismissed publicly as outdated, while quietly accumulated behind closed doors. Central banks spoke of innovation and flexibility, yet their balance sheets told a different story. Gold holdings increased steadily, even as paper assets expanded at a far faster rate. This was not contradiction, it was preparation. Gold re-entered authority not through declarations, but through usage. When trade settles in gold, it bypasses currency risk entirely. Neither party needs to worry about inflation, sanctions, or sudden policy shifts. Settlement becomes final. This finality is what gives gold power in a system struggling with credibility. There's a difference between a gold-backed system and a gold-referenced one. A gold-backed system limits issuance directly. A gold-referenced system uses gold as a measuring stick, forcing currencies to reveal their true value. In both cases, discipline replaces discretion. Gold imposes rules. It cannot be created to fund deficits. It cannot be adjusted to stimulate growth. These limitations are often criticized, but they serve a purpose. They align spending with resources. They force governments and institutions to prioritize. In doing so, they restore balance between promises made and value delivered. For businesses, this shift carries serious implications. Long-term contracts priced in weakening currencies become unstable. Balance sheets filled with paper claims face silent erosion. In contrast, assets linked to tangible value maintain relevance regardless of policy changes. Gold's return also alters pricing itself. When currencies adjust against gold, what appears as rising prices is often currency decline. This distinction matters for planning. Companies that mistake devaluation for growth misread risk. Those that understand repricing adjust early. This transition is not about replacing technology with metal. It is about anchoring systems to something that cannot be negotiated. Gold does not argue. It does not respond to incentives. It enforces accountability simply by existing. As authority shifts, those who rely on flexibility lose advantage. Those who respect limits gain stability. Gold restores symmetry between labor, capital, and savings. Effort once again translates into preserved value. This is why gold's return is quiet but decisive. It does not seek approval. It does not campaign for acceptance. It functions. As gold regained authority and the dollar's dominance quietly eroded, the consequences for businesses, investors, and entrepreneurs became immediate and unavoidable. This was not a distant theoretical scenario. It was a structural shift unfolding in real time. Those who understood the mechanics could act decisively. Those who did not would face risk without even realizing it. Entrepreneurs relying on predictable currency values suddenly faced a hidden vulnerability. Contracts, denominated in dollars, no longer guaranteed consistent purchasing power. Costs for imported goods could rise sharply as the dollar's relative value declined. Supply chains became exposed to fluctuations, not captured in conventional forecasts. Companies with thin margins or high debt obligations were particularly at risk. Financial statements, carefully constructed under assumptions of currency stability, were now potentially misleading. Businesses holding only paper assets found themselves silently devalued. Treasury bills, corporate bonds, and dollar-denominated accounts no longer provided security. They were promises made by a system losing credibility. Conversely, those with tangible assets, gold, silver, land, productive equipment, retained intrinsic value. Physical assets became more than insurance. They became strategic instruments. Financing strategies required reassessment. Debt, once a tool for growth, became a liability when the underlying currency was declining.